Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I want to introduce you to a really smart economics guy tonight. Raymond Wong is his name. He is the Vice President of Data Solutions Delivery, Client Solutions at Altus Analytics. And I've had the opportunity to interact with him about where we are from an economic standpoint, particularly as it relates to real estate, commercial real estate, industrial, office, et cetera. And so I thought it'd be great for Raymond to give us a sense of where we are in the markets today. Raymond, welcome to the show, sir.
Thank you, Brian, and thank you for the opportunity to share our thoughts with you and the listeners.
So, everyone's asking what's going to happen to inflation, interest rates, and thereby real estate prices. So, I was at a conference recently where some person said interest rates are going to stay where they are, and another person said, no, they'll come down by 125 basis points by the end of the year. So that's a pretty wide disparity in judgments, and importantly, the impact on the market. What's your sense of things, sir?
For the past, since January 1, that's been the biggest discussion point with respect to our clients and the real estate sector. And for a long time, we're sort of anticipating interest rates to drop sort of the second half of the year. And then even when they drop, just because of the people sort of wanting to get back into the market from a residential standpoint on the commercial side, that there's also that danger of sort of that possible double dip going back into recession, or based on if inflation starts spiking up again. So we think that interest rates will probably fall in the second half of the year, but probably at between 25, 50 basis points, a little bit slower than what people are hoping for or anticipating. And I think that we're going to see the real pickup going into 2025.
So do you think that that's going to benefit the real estate market, but not until the fall?
Well, everyone is being conservative. Everyone is pushing for interest rate decrease. So even though it might be, and again, it's anyone's opinion at this point, it could be a little bit greater than what we're sort of anticipating. But everyone is getting ready, getting their ducks in a row with respect to applications, getting, speaking on the residential side, getting ready for perhaps a change in momentum, a change in demand. The same thing for the commercial investors. They're lining up, they're shoring up the real estate portfolio. They're looking at certain sectors and property types that they're looking to help them improve their real estate portfolio, and they're spending a lot of time looking at specific assets. So even though the transactions are still pending a little bit, the level of activity in the way of investigating, researching, and looking at certain sectors is ongoing. So everyone's getting ready that once there's a level of stability that we know interest rates are going to drop, that they can get back in quicker to a certain extent before everyone else does. So to try to get those deals that are ideally priced at this point. So it's gonna be a little bit dependent on the interest rates, but it's also going to be based on what people are thinking and where and when they think that might be a good time, based on their investment objectives, based on their expected returns, and how to balance their current portfolios of when to jump back in. So we think that that's going to push in for the first half of the year, and then we'll start to see some of the transactions start happening probably mid-year to the end of the year. But everyone they're not sitting on their hands, but they're very actively looking at the marketplace and looking at possible opportunities.
People may not be sitting on their fans and looking at the marketplace, but what I'm told is that a lot of people that want to do deals are sidelined because vendors, sellers are looking toward the future interest rates, and that cap rates will come down, values will go up, and so therefore they're not willing to transact at today's values, but the purchasers have to finance at today's interest rates, and so therefore they're only willing to buy at today's cap rates, today's interest rates, today's values. And so that therefore there's this bid-ask spread between vendors and purchasers. What's your sense of that marketplace?
Absolutely agree with your comments, Brian. we're still in a period of price discovery based on expectations. To a certain extent, owners don't have to sell unless they're pressured by their investors and based on the what they're holding from a debt side on their portfolios. So they can wait it out to a certain extent, right? So as the anticipation of interest rates and you're right, the whole thing on the math thing, if interest rates fall, cap rates should at least level off because we're anticipating, at least for the next little while, a further increase in cap rates in perhaps office and retail, but also based on where the interest rates are, the more popular products as industrial and multifamily residential as well. So there is this price discovery and bid ask spread between purchasers and vendors based on expectations. Of course, investors are looking for a deal. They're looking at a bit of a discount, and plus, they're also dealing with higher borrowing costs, at least in the interim time period until rates start to come down. So it's just having that balance. So that's why at this period there's a lot of discussion, a lot of investigation, and trying to figure out when to jump back in and which assets should they target their funds or capital at.
So bottom line, people are not on the sidelines, but are, it's a wait and see kind of attitude right now, but with the expectation that with interest rate decreases over the course of the next couple of months, it may become a more attractive market in the fall and hopefully in 2025.
Yep.
We're going to take a break for some messages and be back in just 2 minutes with Ray Wong from Altus talking about the real estate market. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saturday Night 60. My guest tonight is Raymond Wong. He's the real estate market intelligence leader at Altus Group here in Toronto, and we're talking about the real estate market, both commercial and residential, but primarily some of the commercial sectors, and whether we're in for a tough time or a good time from a market standpoint. Raymond's really got quite a fascinating background for the last 6 years. He's been with Altus as Vice President, Data Solutions Client Delivery. Before that, he was the National Director of Research at CBRE. He's also on the Advisory Council of the Real Estate Management Department of the Ted Rogers School of Business at Ryerson University. Executive Director, Americans Research at CBRE, National Director of Research, Board of Directors of the OSCRE, et cetera, et cetera. He's got a bachelor's degree in urban and regional planning from the Toronto Metropolitan University. He's, as I mentioned, a council member at Ryerson, and he's a prolific speaker and writer on economic issues. So Raymond, it's a pleasure to have you with us.
Well,
so can you put sort of where we are in historical context, if you could, given what's happened? Because just a couple of years ago, before the pandemic, with low interest rates, the market was on fire.
Yeah, absolutely, and it's amazing how in the last 6 years the market has turned. And the thing is, we also have to keep in mind that we have been through recessions in the past, and it has impacted the real estate market. So when you look back in the early 1990s, when I started, office vacancy rate downtown was Toronto was at 19%, and industrial was at near 13%, and that's a far cry from the lowest point of the vacancy rates, and that's probably going into 2018 with downtown Class A at less than at one point it was less than 3%, and industrial is down that to that same level. So we've come up a little bit in regards to our current vacancy rate levels at 14.6% for downtown A and 3.3%. Again, but what we're dealing with, we're still dealing with sort of the recession, and don't forget, interest rates back in the early 1990s were at 13% compared to our 5%. So it doesn't seem as bad when you compare it to that far back. But the issue that we dealt with in the early 1990s was lack of demand and overbuilding. The issue we're dealing with today is sort of a pullback in demand, but as well as how we use office space and how it evolves, right? So that's causing a bit of a change and a little bit longer in the way of trying to figure out where the office market is moving towards. But we do know that we're starting to see a plateauing in certain office markets across the country, and industrial remains relatively tight. And they were actually benefit for the last few years based on the increase in e-commerce and the work from home and the logistic area, and remains quite strong.
Raymond, I'm really surprised at your 14% vacancy for a downtown office space, and that it's still growing. You know, everything I hear is that more and more companies are requesting / demanding people come back to the office. So what's happening, do you think?
Well, absolutely. When you look at the return back to the office, that overall on average, downtown people are back in the office about 60%, and that's Monday to Friday. But Tuesday to Thursday, based on 2 or 3 day hybrid work week, that it's between 70 and 80%. And Monday and Fridays, that it's anywhere from 20 to 30%. And again, Brian, as a tip, if you're looking to try to make a restaurant reservation, make it on a Friday or Monday, because Tuesday, Thursday, you're gonna have a tough time because
I gotta tell you, I go into the office every day, and I don't mind it on Mondays and Fridays because my commute is half the time.
I know exactly, right? And that's a challenge with with a big market like Toronto, and because they're reluctant to go back to the 2 to 3 hour commute every day, and they rather just um, be at home and save that commuting time and focus more on work. But in other markets, such as in Ottawa or some of the Southwest Ontario, where people have moved, they actually want to go back into the office, or it's a little bit easier because they have maybe a 15 to half an hour commute at the most. So that's what's causing people not to come back into or a little bit more reluctant to come back into the city because of the commute time. But what we've also seen in the past year is an increase in companies mandating their employees back into the office. So it started with 1 day, 3 days. So that's why you're seeing Tuesday to Thursday, the food court's almost full. At the same time, you also look at the opposite side, whereby companies that mandated 5 days, there are companies that mandated 5 days back in the office are cutting back to 4 days. So we're going to see this continue adjustment, but because we're looking at increased numbers of people coming back in, this will stabilize the office market. But the challenge with Toronto and Vancouver is the overall new supply that was started sort of pre-pandemic are continuing, that are pushing the vacancy rates a little bit higher because of the new supply, and as well as the sort of right sizing of companies sort of adjusting their space needs based on the hybrid model or people coming back into the office.
So do you think lots of companies are adjusting? I heard lots of comments about people going from offices to hot desking, people that would use offices for more than one person because they were in at different times, and they were reducing space. Is that still happening?
Yes, and so everything you mentioned, but we are seeing also some space consolidation. So with Toronto and Union Station, which is a great hub for public transportation, that they're consolidating into central points to allow their employees to come in a little bit easier. So they're consolidating and expanding some office premises in their downtown, and as well as the other side of it is that they're also eliminating some of their space in some of the suburban markets, or going in contrast that they're actually expanding and growing in the suburbs and less so in the downtown. So it really depends on the company strategy, and also depends on what people do and what their roles are. Because what companies are also finding is that there are certain departments that actually work better um, uh, uh, from a home environment and that don't really need to come in. But there are others that require that synergy discussion and that idea brainstorming, and as well as that level of interaction, that they're coming in a little bit more, not just because they're mandated, because they actually want to go back into those type of discussions. And restaurants downtown are starting to come back a little bit. There's still some restaurants or in the food court that are boarded up. But again, they like that interaction. They like that access to restaurants and amenities. But as well, the contrast, you also have to look at that when people are sort of commuting back downtown, they're also facing a little bit higher costs based on parking, public transportation, as well as how sort of food prices have increased over the last few years as well to deal with.
What about industrial? I've heard people comment that they're really worried that we overbuilt industrial and that the very low vacancy rates in industrial will change come in the future. What are you seeing there?
Well, we're already seeing that, Brian. Based on the fourth quarter 2023 numbers, we had a record amount of new construction hitting the industrial market. So when you look at the completions, it was strong. So as a result, the overall availability rates for industrial have increased. So Toronto since first quarter 2023 to fourth quarter increased almost 150 basis points, right? And we're starting to see the industrial rents that we've seen over the past little while have increased on average for sort of your better, more modern industrial buildings, anywhere from 10 to 20% every year, right? And that's on a net basis. And what we're seeing now, because there's a slight increase in the industrial availability rates, it's probably a more moderate increase anticipated for this year. That instead of those 10 to 20, we're looking at anywhere from 3% to perhaps 8% for better quality assets. So it is having a bit of an impact. Part of the impact is that there's more space available, and the other one is that there's also a lot with this increase in occupancy costs. It's also impacting certain companies from trying to bulk or relocate into lower cost areas for industrial, such as when you're in Toronto, southwestern Ontario. But the key thing here is when you look at the industrial completions in fourth quarter. So we have a chart showing the availability rate, and usually when a lot of these buildings, industrial buildings, are complete, because there's so much demand at availability rates before lower than 3%. The availability rate upon completion of the new construction is only between 10 and 20%. So when you look at some of the numbers like Vancouver, close to about 40% upon those buildings completed in fourth quarter were available, Toronto at 67%, and to Calgary at 70.5%. Those are big numbers. So I think we're going to see perhaps a little bit of pullback on construction, because there has been a little bit of speculative construction hitting the marketplace that before the space is leased, that they're actually building premises until this dissipates a little bit. So when we're looking at the overall new supply under construction across Canada, you're looking at slightly over 25 million square feet. Right, so with availability rate of 62%. So again, this is going to take a little while to get through the system, and we're going to see continued strong demand because you're still at minus 4%, or sorry, 4% availability rate. So it's still tight to a certain extent, but you're also seeing a lot more space coming to hit the marketplace. But I don't see any dangers or big cracks on industrial. I see it sort of impacting some of the rents and impacting perhaps a little bit more reluctance to go for the more expensive space rather than try to make do with what they have, or at least the same amount of space going forward.
So, a couple of years ago, people were telling me investing in industrial was a slam dunk. You knew that it was going to get leased up. You knew you were going to get great rents. You knew you were going to get increases. And so therefore, it was a great marketplace to invest. Is what you're saying is that you got to pull back a little bit from investing in industrial space today?
Absolutely not. When you look at when we look at the overall investment transaction activity for industrial, 2022 versus 2023, and we did have a drop. It wasn't because of the drop of demand, right? We were looking at close to 18 billion in 2022, and in 2023 on industrial, we're looking at close to about 14 billion. One is because of where the interest rates were. Two, what you mentioned earlier, Brian, with respect to the bid-ask gap between vendor and purchaser expectation, and the lack of supply in the marketplace. So there is strong demand, but it's also impacting. It costs more to borrow because you have to remember the cap rates on industrial, they have come up a little bit, but before or early parts of probably before the pandemic, you're looking at cap rates around in Toronto between 3.5%, 4.5%. Now we're closer to about 5.5%. You're borrowing at 7%.
That makes no sense. Why would you buy something at 4% when your interest rate is 7% or 6%?
You look at the rental rate increases. And it's also based on the long-term goal and the performance investors use to justify some of these transactions. So they're in there for between 5 and 20 years. So a little bit of negative leveraging at the start of the deal, they'll make up for it, and probably increase in rental rates, plus probably increase in values as well.
I always thought that investors in real estate went on cash, and when cash on cash is negative, that's got to be challenging.
It depends. It depends if on the private side, you're looking at probably leveraging loans, and if you have the good relationships with the banks and institutions, you'll get a little bit more favorable terms. But there are others that that have their own capital pool, that interest rates are a factor, but they're less so because they can fund these transactions themselves. And it also depends on the hold. So if you're a short-term investor, you're looking to turn around 2 to 3 years, you're probably not going to buy that industrial cap rate at 5%. So you're probably looking at something with increased possibility of renewal further upside. So you're looking at a higher cap rate to purchase those type of assets. But to your point, Brian, that it's very difficult sometimes to find certain potential industrial buildings, perhaps a redevelopment down the road to other type of uses, so it's higher and better use of increased value in the land. But interest rates is part of the factor of inflation, and as well as construction costs and replacement value for these buildings that play into whether or not they invested. But definitely when we look at from our client standpoint, that there's a continued strong demand for industrial and as well as on the multi-residential.
We got to take a break for some messages, and we're going to be back in just 2 minutes with Raymond Wong from Altus talking about the real estate market in Canada and where it's going. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Raymond Wong. He's with Altus. He's an expert at analyzing where the real estate market has been and is going. And he's been walking us through where office is. We've been talking about some challenges on Mondays and Fridays with office demand. We've been talking about industrial. He's still extremely positive. Raymond, I got to ask you, based on the chart that you showed, land investments are down like 50%.
Yeah.
Why land investment down so dramatically? Is that all interest rate related?
That is more to do with the interest rates, based on financing an asset that has between 3 to 5 years of no income attributed to it, right? So, and less so regards to some of where the price has moved to with respect to the expectation of the vendor and investor. So this is a bit of a concern to a certain extent that this impacts future pipeline for residential as people a little bit more conservative with respect to land acquisitions. I think this would change as the residential returns and interest rates come off their highs. But is this has definitely fallen off. Like, residential land definitely has really fallen off a lot, and same thing with ICI land, but to a lesser extent because industrial land remains quite active, especially when you're looking at certain prices. Like people are still paying to a certain degree in Vancouver for industrial land at about between 4.5 million an acre, and Toronto anywhere from 1.8 to about 2.3 million an acre.
Hold it. You're saying industrial land in Vancouver is 3 to 4 times as expensive as it is in Toronto?
Yeah. It's the part of the issue is Vancouver has an ocean and they have mountains, right? And there's a very limited supply of land. So
why would anyone open a factory in Vancouver then? Move to Calgary.
Well, that's happening as well. So there are certain companies that can justify, and they have probably smaller warehouses, and there are some big boxes in Vancouver that services Vancouver. But what we've also seen is there are certain logistics companies have moved to Calgary because of look at their land prices, about $500,000. It's a lot cheaper for them to build or lease a industrial building in Calgary and ship it back over to the mountains. So get everything shipped to Calgary and then ship it back for on demand basis.
That's
so
incredible, the difference. The only sector that you showed going up was hotels. So yeah. Hotels were obviously really negatively impacted by the pandemic. Are people investing in hotels again?
To a certain extent. If Brian, you probably traveled in the past year, and we definitely the room rates have increased, and so that's become an interesting asset class because you look at the return of tourism to a certain extent, and people are traveling again, and the numbers are going up. But the other thing you're seeing, especially with this office hybrid thing, and people have moved to, Southwestern Ontario, they moved to Belleville, they moved outside, even though the job is in Toronto. And with the mandate to back to the office, some of those people, if they have to be here for 3 days or be in Toronto 3 days a week, they'll come in on the Monday night and just rent a room for 2 or 3 nights and then go back home before the weekend, right? So you have an increase in tourism. And business travel is back. In addition to some of the large markets, you're having people rent out midweek so they can be in the office 3 days a week and not have to try to move back to Toronto or the larger urban markets with the higher housing prices.
What's happening in retail? You show about a 30% decline.
You know what? Retail has been so consistent over the last 5 years and through the pandemic, better so than the office side. And because one of the most popular products for investors is food anchor grocery retail, and that, as you know, grocery anchor retailers have done quite well over through the period of the pandemic. And retail also represents future redevelopment play and mixed uses, especially for retail and residential, right? And you're seeing a lot of the big malls with Yorkdale, Baby Village in Toronto. They've applied for increased or zoning changes to allow for residential development on the site. right? So further trying to increase the value of this retail property. So from an investor redevelopment aspect, retail remains quite strong, and especially that we're still seeing. We've been talking about retail for so many years. It's constantly going through transformation. You look at the Cloverdale Mall in Toronto, they're reassigning some of that space for pickleball courts.
Well, they're redeveloping the whole place. It's just unbelievable. So Ray, the redevelopment at Cloverdale Mall, Oxford is planning something like 8 towers at Yorkdale. There's towers planned at Scarborough Town Center. It almost seems like a whole bunch of these malls are turning into towns.
Well, it's cool, right? When you look at the Vaughan Metropolitan Center, and you have to remember a number of years ago that was all industrial. Now it's connected to the subway line. You can be in downtown in 40 minutes. You have a combination of office, residential, and retail in that site. So it is becoming a community, and plus you have sort of a consumers, or you have customers that are within walking distance of your development, right? So, and it's going to cause a lot more foot traffic in those areas with respect to not just the retail shopping, but the restaurants and other type of uses. And Cloverdale Mall, it's pickleball, right? So there's a strong movement to move that direction, more of a community, more of a neighborhood, rather than just a single destination for retail.
So overall, where do you think investors want to invest today?
You know what? My favorite is still industrial multifamily, only because that they're consistent and there's upward potential, but there's also good opportunities. I still think on the office side for the redevelopment opportunities, as well as we're seeing some office convergence on the retail side. So I see sort of opportunities in all those areas, but it depends on the right time and the investor expectation on returns. And as well as, I also think that we didn't touch upon it, but we do benefit from the population increases and increase in spending and how that's impacting the GDP going forward.
You've got another chart in 1 or 2 slides that I was shocked at. Shows that people want to invest in suburban multi-unit residential, and that's one of the best markets. And suburban office space, one of the worst markets. So it's really going from office in the suburbs to residential in the suburbs.
Again, if you look at that suburban B office, there is opportunity there because you also have location and land, right? So for some person, based on their objectives, that it will be further down the list. But if you look at some of the office transactions that are taking place in the last couple of years, there are opportunity plays, right? They're going to rent it out as office for now, and eventually they're going to demolish it and use it for some sort of residential or mixed use down the road. But for now, it still has half piece income. They got it at a price that they could manage, and as well as help with their portfolio. So it really depends on the investor. Again, you're looking at perhaps a little bit lower cap rates for apartment and residential because there's so many bidders in that area, but there's definitely opportunities to be had based on each of the sectors, depending on where you're looking and which markets.
What about city across the country?
Sorry?
The cities across the country, where do you see demand in the geography across the country?
So is typical with respect to the big markets with a lot of attention is Vancouver, Toronto, and Montreal, because of population size and diversity. But if you look at Calgary, Alberta has done really quite well over the past few years, just because from affordability standpoint and work from home. And there's been a lot of talent that have moved to Alberta. So they're in a really good position going forward. And companies are looking to look for talent, and as well as the 25% sort of office vacancy rate in downtown Calgary has created some opportunities, as well as from a price standpoint, to make it very competitive for companies to be in there. So from a investor standpoint, that it depends on what they're looking at. But even with respect to the Southwestern Ontario, you see that growth on the auto sector and battery plants, and from Ottawa as well, with the resurgence of the tech sector. I think there's opportunities to be had in all the markets, but the biggest markets are Vancouver, Toronto, and Montreal. But again, it depends on what your investment criteria is.
If you flip forward 2 slides, I think this is really quite interesting. What you show is about a 30% decline in the value of transactions and 30% or so decline in the number of transactions. Go back a slide, in the Greater Toronto Area. Like, that's, even though it's high relative to where we were 5 years ago, it's a dramatic decline since 2021.
Yeah, but Brian, I'm not sure if that's the normal, because 2021 transactions was based on the deals because of the shutdowns that didn't happen in 2020, closed in 2021. So that's a bit of an anomaly. 2022 was a bit of a hangover from 2021. When you look at 2023, it's slightly lower than the pre-pandemic numbers, and maybe the numbers a little bit higher than that. But again, based on the interest rates, based on inflation, and as well as that threat of a recession, it's come down to that percentage, but I'm not sure if that's the norm going forward. I think in 2023 that we're going to probably be near or a little bit above that number in the way of transactions as investors come back to the marketplace. So yeah, I recognize the drop in 22 and 23, but I'm not sure if the 21 and 22 were sort of anomalies in the marketplace.
So Ray, where are you? Is this a good time to be a real estate investor, or a crappy time to be a real estate investor?
I'm always on it's strange enough, I'm sort of on the positive side. I think it's a great time and it depends on the timing and depending on the expectations that and there are a lot of smart people on the investment side that are being creative with deals. So I think it's anytime there's market movement and market transition, especially where we're seeing the interest rates and as well as where we see the global market sort of moving towards, I think it's a great time to be an investor.
Ray Wong from Altus, I really appreciate you joining us and telling us where the real estate market has gone, is going, and what your expectations are. Really appreciate it.
Great. Really enjoyed the talk, Brian. Thank you.
We're going to take a final break, and I'm going to come back with some of my own comments in just 2 minutes. Stay with us, everyone. Ray Wong from Altus Group. Thank you very much.